Warren Buffett holds $169 billion that isn't his.
He didn't borrow it. No bank lent it.
And he pays almost nothing to keep it. Sometimes, he gets paid to hold it.
This is the closest thing to free money that exists in legal finance. It's called float.
And once you understand it, you'll never look at an insurance company the same way again. Here's the whole idea in one breath. Insurance companies collect your premiums today and pay claims years later. That gap, that pile of cash sitting in between, is what they get to invest. Today you'll learn exactly how float works, why it's so powerful, and the one condition that turns it from a gift into a trap.
Think about your own car insurance.
You pay $600 today.
You might not file a claim for 3 years, maybe never.
So where does that $600 go?
It sits with the insurer.
And multiply that by millions of customers, and you get an ocean of cash.
That ocean is float. Now here's the part most people miss. That money legally belongs to the policyholders. But until claims come due, the insurer gets to invest every dollar of it. They keep the investment returns. Buffett said it best in his shareholder letters: float is money we hold but don't own. So the question becomes obvious: what if you were brilliant at investing that ocean?
But here's where it gets really interesting. In 1967, Buffett made a move almost no one understood. He paid $8.6 million for a small, boring insurer called National Indemnity. People scratched their heads.
Insurance? It's slow. It's unglamorous. But Buffett wasn't buying the insurance business. He was buying the float machine underneath it. Watch what happened. In 1970, Berkshire's float was $39 million.
By 2023, it had grown to roughly $169 billion.
That's cash Buffett could pour into Coca-Cola, into Apple, into See's Candies, compounding for decades.
He was investing with a giant pool of money that cost him almost nothing to access.
Quick question for you, and I want your answer in the comments. If someone handed you $100 billion to invest, but you had to hand it back someday, would you take the deal? Yes or no? Because the answer isn't as simple as it sounds. And that brings us to the trap. Here's what nobody tells you about float.
It's only free if the insurance business breaks even or better.
Let me explain.
If an insurer collects $1 billion in premiums but pays out $1.1 billion in claims and expenses, it lost $100 million running the business.
That loss is the cost of the float.
And this is the counterintuitive truth most investors get completely backwards.
They assume all insurance float is cheap money. It isn't. Bad insurers, the ones that underprice policies to win customers, end up paying dearly for their float.
Their free money quietly bleeds them.
But Berkshire? For many years, its insurance operations ran at an underwriting profit. Think about what that means. Buffett got paid to hold other people's money. That's the magic. Negative cost float. Money that pays you to keep it, which you then invest for more money. It's a machine that runs in two directions at once. So the real skill was never just collecting float. It was underwriting discipline, refusing to write a bad policy just to grow. And that discipline is the whole game. You don't run an insurance company. So why should you care? Because float reveals how the best businesses actually work. Look around, this pattern is everywhere. Costco collects membership fees upfront. Software companies bill annually in advance.
These businesses get their customers to fund their growth. When you analyze a company, ask one question. Does it collect cash before it delivers the product? If yes, it might have its own quiet version of float, a structural advantage hiding in plain sight.
That's the lens.
And it separates good businesses from great ones. Remember what I said at the start, $169 billion that isn't his. Now you know how he got it and why almost no one saw it coming.
Float is the quiet genius of Berkshire Hathaway. Not stock picking. Not luck.
A structural engine that let Buffett invest with other people's money at almost no cost for over 50 years.
So here's the one line I want you to remember.
The best businesses don't just make money, they get their customers to fund the making of it.
And that's not a get-rich-quick trick. It's a way of seeing. This is educational content, not financial advice. Always do your own research.
But once you see float, you start spotting it everywhere.
So here's my question: would you take $100 billion to invest if you had to give it back someday? Yes or no, tell me below.
And tomorrow, we're breaking down the one number on a balance sheet that reveals whether a company is quietly drowning in debt. You won't want to miss it.